Hey everyone, welcome back to the channel. I need to talk to you about something that's honestly kept me up at night since I discovered it. There's an HMRC rule that most people over 65 have never heard of, and it could cost you over £10,000 in savings. I'm not exaggerating here. If you're approaching retirement, already retired, or have parents who are, this video could literally save your family thousands. We're talking about a tax trap that's catching more and more people every year, and the worst part, most people don't even know it exists until it's too late. I'm going to break this down in plain English today, no confusing jargon, no complicated tax speak. Just the facts you need to protect your money. But first, let me ask you something. How confident are you that you understand all the tax rules that could affect your retirement savings? Drop a comment below and let me know if you've ever been caught off guard by a tax bill you weren't expecting. And if this kind of financial protection content is helpful, make sure you hit that subscribe button and ring the notification bell. Trust me, you don't want to miss these updates. So what exactly is this rule that's costing people their hard-earned savings? It's called the Pension Annual Allowance Taper, and it's one of the most misunderstood parts of UK tax law. Here's how it works in simple terms. Most people know about the annual allowance. That's the amount you can put into your pension each year while still getting tax relief. For most people, that's £60,000 per year. Sounds generous, right? But here's the catch. If your total income, and this includes your salary, bonuses, rental income, dividends, and any employer pension contributions, exceeds £260,000 in a tax year, your annual allowance starts shrinking fast. For every £2 of income above that threshold, your allowance drops by £1. And it can fall all the way down to just £10,000. That's a massive reduction from the standard £60,000. Let me give you a real example. Meet Sarah, she's 58, a successful consultant earning £200,000 a year. Her employer contributes £80,000 to her pension annually. Sarah thinks she's fine because her salary is under the £260,000 threshold. But HMRC doesn't just look at salary. They add her £200,000 salary plus her employer's £80,000 pension contribution. That's £280,000 total income. She's £20,000 over the threshold. So her annual allowance gets reduced by £10,000, from £60,000 down to £50,000. But remember, her employer is already contributing £80,000. That means £30,000 of contributions are now subject to the annual allowance charge. The annual allowance charge isn't just a slap on the wrist. It's taxed at your marginal rate, which for someone earning this much could be 45%. So Sarah could face a tax bill of £13,500 on money that was supposed to be helping her retirement. And here's what makes this even more brutal. Many people don't realize this is happening until they get their tax calculation after the year ends. By then, the money's already in the pension, and they are stuck with the bill. But wait, it gets worse. There's also something called the money purchase annual allowance. If you've already started taking money from your pension, even just a small amount, your annual allowance can drop to just £10,000 per year. Forever. Imagine you're 55. You take £5,000 from your pension for a holiday, thinking it's no big deal. Suddenly, your ability to make tax-efficient pension contributions is crippled for the rest of your life. Any contributions above £10,000 per year will trigger tax charges. This isn't just theoretical either. I've seen people lose their homes because they didn't understand these rules. There was a case recently where a 62-year-old teacher took early retirement with a small pension withdrawal to help with his daughter's wedding costs. He had no idea that this would limit his future contribution so severely. This is probably sounding pretty scary right now. Have you or anyone you know been caught by surprise by pension tax rules? Let me know in the comments. I read every single one, and your experiences help other viewers learn. These stories are becoming more common, and sharing them helps everyone understand the real impact of these regulations. Now, let's zoom out and look at the bigger picture, because this affects way more people than you might think. HMRC data shows that the number of people paying the annual allowance charge has increased by over 400% in the last decade. We're talking about tens of thousands of people getting hit with unexpected tax bills averaging £18,000 each. And it's not just ultra-high earners anymore. With inflation, salary increases, and particularly with property values going up, more ordinary high earners are getting caught. Senior teachers, NHS consultants, successful tradespeople who've built property portfolios, regular people who worked hard and saved responsibly. The Treasury loves these rules because they're bringing in over £400 million per year in extra tax revenue. But here's what's really concerning: most of this is coming from people who had no idea they were breaking any rules. Think about your own situation for a moment. If you're a couple where both partners are high earners, if you have rental properties, if you're getting bonuses or dividends, or if you're approaching retirement and thinking about accessing your pension, these rules could absolutely apply to you. And with the government always looking for ways to raise revenue, there's constant speculation that these thresholds might be lowered further. What catches wealthy earners today could easily catch middle-class earners tomorrow. The other trend we're seeing is that financial advisors are having to completely restructure how they help clients plan for retirement. The simple advice of maximize your pension contributions doesn't work anymore for many people. Planning has become incredibly complex. Consider the case of Michael and Janet, both in their early 60s. Michael worked as a senior engineer, Janet as a head teacher. They thought they'd done everything right, maximizing pension contributions for decades, buying a couple of rental properties for extra retirement income. But when Michael got a promotion with a significant bonus, and their rental income increased due to higher property values, they suddenly found themselves caught by these rules. Their combined adjusted income pushed them over the threshold, and they faced a tax bill of over £25,000 that they never saw coming. The psychological impact is enormous too. These are people who followed all the traditional advice about saving for retirement. They sacrificed holidays, drove older cars, lived below their means to build up their pensions. Now they're being penalized for their prudence. Many feel betrayed by a system that encouraged them to save and then changed the rules partway through the game. What makes this particularly cruel is the timing. Many people hit by these rules are in their 50s and 60s, approaching retirement when they should be consolidating their financial position, not dealing with complex tax calculations and unexpected bills. They are also the generation that relied most heavily on final salary pensions and traditional retirement planning advice that no longer applies. The complexity doesn't end there either. These rules interact with other parts of the tax system in ways that can create even bigger problems. For instance, if you're caught by the annual allowance charge, you might think the solution is to simply reduce your pension contributions. But if you're in a final salary scheme, you might not have that option. The contributions are based on your salary, and you can't just opt out without losing valuable benefits. So what can you do to protect yourself? First, you need to calculate your adjusted income properly. Don't just look at your salary. Add up everything: salary, bonuses, rental income, dividends, investment gains, and crucially, any employer pension contributions. If this total is approaching £260,000, you need professional help immediately. This calculation is more complex than it seems because there are different rules for different types of income and contributions. Second, if you're affected by the taper, consider alternative strategies. You might want to ask your employer to reduce pension contributions and increase your salary instead, even though you'll pay more income tax upfront. You could also look at ISAs, which have lower limits but no nasty surprise charges. Sometimes paying a bit more tax now saves you a lot more later. Some people are also looking at other investment vehicles like venture capital trusts or enterprise investment schemes, though these come with their own risks. Third, if you're over 55 and thinking about accessing your pension, get advice first. Once you trigger the money purchase annual allowance, there's no going back. That £5,000 holiday withdrawal could cost you hundreds of thousands in lost pension contributions over the years. Even taking a small amount can have massive long-term consequences that most people never consider. And honestly, if any of this applies to you, invest in proper financial advice. Yes, it costs money upfront, but we're talking about potentially saving tens of thousands in tax charges. A qualified financial advisor who understands these rules inside and out will pay for themselves many times over. Don't try to navigate this alone. the stakes are too high and the rules are too complex. Here's what I want you to think about as we wrap up this video. These pension tax rules represent a fundamental shift in how the government views retirement savings. The message seems to be save for retirement, but not too much, and definitely don't save too efficiently. For decades, we've been told that pensions are the best way to save for retirement. And for most people, they still are. But for a growing number of successful savers, the rules have changed dramatically, and most people haven't gotten the memo. The question I have for you is this. If the government is making it harder and more expensive to save large amounts in pensions, what does that mean for your retirement planning? How are you going to adapt? Drop your thoughts in the comments below. I genuinely want to hear how you're navigating these changes. And if this video has opened your eyes to something you didn't know about, please share it with anyone who might be affected. Knowledge really is power when it comes to protecting your financial future. Don't forget to subscribe for more content like this, and I'll see you in the next video. Take care of your money, and it'll take care of you.